Hi there, my name is Jordan Lee and I'm a mortgage lender based out of Portland, Oregon, and I wanted to chat with you quickly today about what a 5/1 ARM is. That's right, a 5/1 adjustable rate mortgage. Most of you are probably familiar with a 30-year fixed rate mortgage, which means you have 360 payments that are the same principal and interest amount for 30 years. Uh, Generally speaking, that's the most common product that a lot of people are familiar with and select in their mortgage process. You might have seen advertised what's called a 5/1 ARM because it has a lower interest rate. These loans are able to provide a lower interest rate because they're less risky to investors. So if you're an investor and you're lending a lot of people money, and inflation was going up, which meant that mortgage rates were eventually going to go up in a few years, suddenly that return on a 30-year fix isn't as good for you anymore. So if you offer a 5/1 ARM and inflation goes up, the rate will also go up for your clients over time, which will kind of hedge that risk for you so you can offer a lower start rate. So let's break down a little bit what this 5/1 ARM actually means. And here's kind of an example of a product that you might see, a 5/1 LIBOR ARM with a margin of 2.75 and caps of 226. So this is still a 30-year fixed mortgage in most cases, and so that first 5 means it's fixed for the first 5 years, and then that 1 means that every year after that it will adjust. LIBOR is the index that it's based on. LIBOR stands for the London Interbank Offered Rate, and here's the index going back to 1986, and you can see that over the last 2 recessions, going back to 2002, these gray areas are recessions. Rates haven't changed a crazy amount. At the peak here, we're seeing 5%, and the trough at about 0.5%. But in the past, rates have been significantly high on the LIBOR. This ARM just means adjustable rate mortgage, meaning it's not fixed for 30 years. It will adjust after a 5-year period. And then the margin is, in this case, 2.75. So you would take, when your 5-year period ends, you would take that LIBOR index, whatever that was at, and add 2.75, and that's what your rate would be. So if LIBOR was still at 0.5%, your rate would be at 3.25. And then on conventional loans, these ARMs, or adjustable rate mortgages, are still regulated. You have to disclose all these things with the loan estimate. There's various caps. So in this example, there is an initial cap of 2%, meaning that when your first 5-year adjustment or first 5-year fixed period ends, it can adjust up to 2% more. So you'd be capped at 7% after the first adjustment period. And then every year after that, the most it could increase in one period is 2%. And then over the lifetime of the loan, the most it could get increased was 6%. So if you started at your loan at 3%, after 5 years, the most it could be could go up to at the first adjustment would be 5%, and then the next year 7%, and for the life of the loan, the most it could go up to would be 9%. And sometimes these loans have a floor on them, so in some of them the floor is 0, and some of it's 3 or 5%. So it'll just kind of depend on the loan. So in this example, the difference between 3 and 9% is pretty significant. So if you were doing a $350,000 mortgage at 3%, your monthly payment would be about $1,475. But if it went up to 9% after 9 years, your monthly payment would practically double, and it would go up to $2,816. So it's really important that when you're looking at one of these products, you understand what the consequences of them could be. So you might ask, like, what are the benefits? Why would you ever want to do this? Well, one benefit is that you start with a lower rate or initial payment, and some of them are for 7 years or even 10 years fixed, and for a lot of people that could be a long time. So if you were planning on selling, like you knew you were going to have to relocate, or you're like, well, I'm planning on refinancing because I need to take somebody off the loan. My parents helped me co-sign, but they wanted me to refinance after 3 years. In those circumstances, that might be something worth considering as long as you understand the risk, because it could save you, thousands of dollars in that first 5-year period. If you have any questions about adjustable rate mortgages, please feel free to reach out anytime. I'd be happy to help out, and I'll put my contact information in the comments below.